Live from Bloomberg's world headquarters in New York, I'm Haley Lyons.
And I'm Kriti Gupta, stepping in for Matt Miller. Welcome to Bloomberg Crypto, a look at the people, transactions, and technology shaping the world of decentralized finance.
Coming up on today's show, waiting for Powell. Crypto is one of the risk assets potentially impacted by the Fed's annual symposium in Jackson Hole. We'll hear from investor Mike Alfred of Eaglebrook Advisors.
And pressure is mounting on Bitcoin miners. We'll drill down on the struggling sector with the CEO of Core Scientific, Mike Levitt, joins us.
And Terra's collapse sparked a wave of redemptions for Tether that the stablecoin has yet to recover from. We'll assess the damage done. So all of that is ahead. First, though, let's get a snapshot of the markets. The best way to do that on your Bloomberg terminal, CRYP Go. That is your function. And you'll actually see that cryptocurrencies are outperforming equities today. Bitcoin is up about 1.5%. Still, though, we remain in that $21,000 area of activity. And Ether actually gaining a little bit more, nearly 4 percentage points as we get closer and closer to the merge coming in a couple of weeks. It's trading right around 1637. And of course, that merge will move Ether from a proof of work system, i.e. one that depends on mining, to proof of stake. And on the subject of mining, you're seeing a nice lift for some of those Bitcoin and crypto miners as well. Marathon Digital up about 5%. Core Scientific, which we'll be speaking to later in the program, up about 4.5% on the day, Kriti. But of course, it has been a very, very painful year for many of these names.
Well, speaking of just a painful year, the mighty have certainly fallen. It's not just about the miners, Kaylee. It's about the exchanges as well. Think Robinhood, think Coinbase as well. Essentially the ways to play the crypto boom into the stock market. Well, it has all completely collapsed. In fact, you're looking at the likes of MicroStrategy, for example, which was a direct investor in Bitcoin. Compare that to the likes of Riot Blockchain, a miner similar to the likes of Marathon Digital that you were just mentioning. You also have the like I said, of Robinhood, Coinbase. So what is the best way to play it? Well, for a very long time, it used to be Coinbase, just given that exposure to the dearth, or I should say the plethora, actually, of the cryptocurrencies that you had. Now it looks like it's that direct exposure that's outperforming. MicroStrategy in particular, this white line here, you can see outperforming the broader cryptocurrency plays. Whether or not that actually sticks is going to be the key question. Let's get back to digital assets, though, because at the end of the day, a lot of uncertainty when it comes to those financial markets. Take a listen to what some of those market participants had to say.
This is not our first bear market in crypto. It's our third one.
Macro environment is really tough right now. Inflation seems to be, out of control.
Traditional venture firms and hedge funds that started digging into crypto have pulled back.
Retail investors have maybe pulled back.
The uncertainty around the legal and regulatory environment is leaving institutions in kind of a middling position.
This tornado cash issue that's come up is a real issue.
We'll see a constitutional challenge against Tornado Cash.
We will start to get some announcements after Labor Day around things that the crypto community cares about, legislation, regulation.
And there's an intense debate around mining as the best way to secure crypto assets, from concerns around energy consumption to financial difficulties brought on by declining Bitcoin prices. Some of the biggest companies, well, they're under pressure. Bloomberg's Sonali Basak is here to explain. Sonali.
It certainly is a major question of the day, Kriti, because Bitcoin is consuming an estimated 92 terawatts an hour of electricity annualized, according to Cambridge University. And at the upper bound of those estimates, it's consuming more than many large countries. Last year, it consumed more energy than all of Argentina, a country with a population of 45 million, where many Argentines do believe crypto is safer than their own volatile currency. Nick Carter of Castle Island Ventures drew out the two sides to this debate for Harvard Business Review last year, and he said if you believe that Bitcoin has no utility besides serving as a Ponzi scheme or money laundering device, you would think the consumption is wasteful. But for tens of millions of people, it's a tool to escape monetary repression, inflation, and capital controls. Those people would find the energy use, which is less than 1% of total global consumption, useful. When China banned crypto mining last year, miners moved to countries that would be much friendlier, and many headed to Texas, where extreme temperatures this year has put pressure on companies who are rushing to keep their servers cool. The power grid there also tends to face outages, and the companies this year have faced serious impairments on their Bitcoin holdings. The industry, which is also loaded with debt, is facing a reckoning. And while stocks have recovered some, they have still lost more than half their value in the second quarter alone. The three largest publicly traded miners lost more than $1 billion.
Absolutely brutal. Sonali Bosick, thank you so much for that great roundup. Let's continue the conversation on the miners. Joining us now is Mike Alfred, a board member of Iris Energy, which is a Bitcoin miner, and he's also on the board of Eaglebrook Advisors, a crypto-focused investment firm. So, Mike, as Sonali just laid out, there's a lot of issues in the mining space, and it has been a pretty brutal time for the miners in terms of market performance. What's your confidence level that they're through the worst of it?
Brutal is the right word. It's certainly been a difficult time, and I was with a bunch of the miners in Miami about a month ago now, and the mood's a little darker. The Bitcoin price being under 20,000 obviously isn't good for anyone because profitability tends to flip negative for a lot of the large miners around those levels. The cost of machines has gone down though, so if you're a buyer of machines here, you're getting a much better price than you were a year ago. And energy prices, while they're going up, they could certainly, be held down a little bit by macro uncertainty, at least in the U.S., where there's sort of an oversupply of energy. So I actually believe, just based on the hash ribbons, which is a metric that looks at the 30-day moving average of the global hash rate relative to the 60-day, it just flipped positive again in the last week, right after being negative since sort of some point during July. I actually think the capitulation phase is over. There were miners that were literally buying Bitcoin at 40,000, and then they puked that Bitcoin back into the market at 20. I think that speaks to the general strategy that people should have around their balance sheet here. I think there's two strategies that sort of work well. One is just selling your Bitcoin every day, the way Iris Energy does, and that way you can grow just out of cash flow. Or like HUD 8, just holding the Bitcoin indefinitely, but using equity and debt strategically and not taking on too much debt, and then growing at a reasonable speed so that you don't get caught at the wrong part of the cycle flat-footed.
Mike, there's a multitude of different types of miners, specifically those that control their own infrastructure, for example. What is the market getting wrong about the nuances in that arena?
That's a really key point. And, the market just generally, the buy and sell side, they don't really understand Bitcoin. So let's just start there. It's hard to understand why you would mine Bitcoin if you don't understand what Bitcoin is. But then within the Bitcoin miners, there's this huge divergence between the folks that are actually developing their own infrastructure, right? They're actually facing off directly with power markets. They're not behind the meter or borrowing somebody else's power. And then they build their own data centers, right? So they have control over their operating environment. They control their heat engineering. They select directly whether to use air cooled, or they use immersion, or they use hydro. And so what we're seeing is this divergence in operating metrics and actual efficiency and being able to deliver results based on whether or not these firms control their own infrastructure. And funny enough, though, the firms that have the highest trading volume in a lot of cases are the firms that generally have decided to use an asset light model, which it turns out has a lot of issues because if you don't control your operating environment, you could have 100,000 plus machines, but not be able to actually plug them in. And so the market is sort of giving higher multiple to firms that have higher trading volume, whether or not they're actually proving to have operational execution and excellence. And I think that is a mistake that will be rectified over time.
Well, Mike, it sounds like this is really an operation that values scale, that values being able to mine in bulk. But I'm curious how that squares with, say, some of the costs associated with this massive increase in power.
Yeah, so I mean, look, if you're in Europe right now, I don't envy you at all, and I think this speaks to geographic diversity as well. The miners that I think have the best future are going to be able to operate in multiple different jurisdictions, so that if they are experiencing either regulatory issues or power price issues in a given market, they're able to shift their machines and their production from environment to environment to take advantage of any arbitrage that could exist there. So power prices are going to be a real issue. Particularly in places where there are supply chain related issues, like in Europe. Whereas Canada, and I think most of North America broadly, looks pretty good because we have sort of an oversupply of renewable energy. In the panhandle alone of Texas, there's something like 20 gigawatts of excess power that's basically not used because there's no way to get that power down to the load centers down into the south. That's the power that's being soaked up by Bitcoin miners, and we don't expect the price of that to go up astronomically simply because there's so much of it.
Well, of course, the use of power is one of the frequent criticisms of mining and proof of work systems. But Mike, we know that, well, we don't know. We think that in mid-September, the merge may finally happen. Ethereum will move from proof of work to proof of stake. How does the upcoming merge affect your view on how you want to be investing in these kinds of companies?
Well, I think the Bitcoin only miners are always going to be a good bet, because if you believe in a truly decentralized monetary system, it will not function properly under a proof of stake model. So as much as Ethereum could be an interesting currency for doing NFTs or right doing DeFi or whatever, it's not going to be the same thing that Bitcoin is if it moves off of proof of work. And so I don't think it changes anything with the thesis. Like if people want to speculate on NFTs, right, that doesn't bother me one bit. I'm a free market capitalist. But if you want to own a truly hard asset with a supply cap that cannot be disrupted, that cannot be sort of taken over by any one party, you kind of need to stick with proof of work. And therefore, I think Bitcoin mining, at least again in North America, has a great future.
All right, great to get your insights and have you back on the program. Mike Alfred of Iris Energy and Eaglebrook Advisors, thank you so much. Now coming up, we'll continue our mining conversation and speak with the head of the largest U.S. publicly traded Bitcoin miner by computing power, Mike Levitt of Core Scientific will join us.
And Tether's second quarter is showing the impact of the Terra collapse. More on the future of stablecoins ahead.
And of course, to access all of the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg.
This is Bloomberg Crypto. I'm Kriti Gupta with Kaylee Lines. Matt Miller is off this week. The collapse of cryptocurrency prices and high energy costs have compressed profit for Bitcoin miners. Core Scientific, for example, the largest U.S. publicly traded Bitcoin miner by computing power, reported a second quarter loss of $862 million. Mike Levitt, the company's co-founder, co-chairman, and CEO, joins us now. Mike, thank you as always for joining us. I'm curious about, let's start with the price action here. Of course, we've seen this massive hit in Bitcoin prices specifically. If you continue to see this drop in cryptocurrencies and perhaps the price level even staying steady to where it is, how is Core Scientific going to stay afloat?
Well, first of all, thank you for having me. Appreciate being invited. And there is a big difference between a stated loss and being cash flow generative. And our loss, as is the case with a number of the other mining companies that was stated for this past quarter, really had more to do with non-cash charges, goodwill and asset impairments, as opposed to operating losses. Even at these levels, Bitcoin mining continues to be a cash flow positive business for us as well as other mining companies.
And yet, to boost your cash position, you also sold a large amount of your Bitcoin holdings this year. Are you on a firm enough footing now that you don't think you will need to sell anymore?
We're very comfortable with our position, our capital, and our balance sheet. As I've said in a couple of earnings calls, we think in an environment like this, a tumultuous, distressed environment, makes a lot of sense to be very liquid. It makes sense because we can take advantage of opportunities that may arise. It makes sense just because it's a sensible thing for companies like us to do. Additionally, we continue to grow in this environment, and selling our Bitcoin funds our growth. We're still on target for what we believe will be a very strong growth year.
And obviously, as we talk about the environment, it's been difficult from a market performance perspective, just with the idea that the Federal Reserve and other central banks are tightening policy. But there are also other factors that are difficult for miners, like climate, for example, and the environment. We've seen heat waves, stresses to the power grid. You have an operation in Texas, which I know is only about 15% of your total mining operation, and yet we've seen real strain there, and you actually voluntarily shut down some of your operations for certain peak hours of the day during the latest heat wave. How great is the climate challenge for you, and does that ultimately mean that in places like Texas, for example, your footprint actually is going to go down to zero?
Well, no, we're not planning on exiting Texas. We still think that Texas is a good place for our business. So there's no contemplation of exiting Texas. With regard to our curtailing or downpowering machines, we do that in all of our locations. We're in 5 different states, 8 data centers. And we have always viewed ourselves as being supportive of grid operations wherever we are. We're an asset to the grid in our ability to use excess energy when it's available and to downpower on the spur of the moment when it's needed to help stabilize the grid. we'll continue to do that in Texas as well as the other states in which we operate.
But Mike, that flexibility that you just outlined is something very unique, I would say, to the United States. If you were a miner, for example, in Europe, perhaps not, you don't have that flexibility. I'm curious how that eats into perhaps a scaling up when it comes to mining in bulk.
Well, it certainly does have an impact on overall operations, but we budget into our plans every year a certain amount of down powering or curtailing of our activities. We know that it's going to get hot in Texas, and there'll be a bit of excess demand on the grid in Texas. So we budget in a certain number of hours. It's been hotter than usual in Texas. I happen to live in Texas, and I think at last count we had something like 58 days over 100 degrees in Austin, where I live. But we also budget in doing that in our other locations, Georgia, Kentucky, North Carolina. Pretty much the only place we don't need to budget that in is in North Dakota.
Well, as a Dallas native myself, of course, we know that we are no strangers as Texans to heat for certain in that state. Let's talk about the climate crisis, though. Of course, we know temperatures globally are rising. Are you concerned at all about the criticism that this industry is really contributing to that climate crisis?
Certainly, I'm concerned about the criticism, but what we all hope is that, in fact, the reality of it will ultimately come to be understood. We locate our facilities where we believe there is excess power. We think, in fact, that we provide a benefit to the grid, and we are an asset when it comes to encouraging and assisting in the development of more renewable energy. We, as an industry in the United States, we use roughly 1.5 times more renewable energy than the average in the United States. And so we're here to help, in fact, the grid. We're here to help the development of renewable energy. We are concerned about the criticism, and that's why we're trying to, in fact, help people understand what we in reality do and what our impact in reality is on the grid and the provision of power where we're located.
All right, Mike Levitt, we will have to leave it there, but thank you so much for joining us today, and hopefully we can get you back one day soon. He is the co-founder, co-chairman, and CEO of Core Scientific. Really appreciate his time. And don't forget to be sure to check out our Bloomberg Crypto podcast, which dives deeper than the daily market buzz to explore how this asset class is changing the way we live. Look for that every week through the Bloomberg Professional app, iHeartRadio, or wherever you get your podcasts. This is Bloomberg. This is Bloomberg Crypto. I'm Kaylee Glines with Kriti Gupta. Matt Miller is off this week. Now let's talk about some crypto stories that caught our eye this week. A much anticipated upgrade to Ethereum may risk altering the power structure of the cryptocurrency network. The so-called merge will create new participants in the blockchain ecosystem called builders. Because only a handful of builders are committed, Ethereum's new system could initially be more centralized, with builders commanding higher fees.
And the FDIC has ordered crypto exchange FTX along with 4 other companies to correct, quote, false or misleading statements about certain products being eligible for insurance protection. This comes after similar action against bankrupt crypto platform Voyager Digital in July. The agency has been ramping up efforts to crack down on businesses in the digital asset space.
And Tether's total assets dropped by almost 20% in the second quarter, according to a report. In May, the collapse of algorithmic stablecoin Terra USD sent the crypto market reeling and prompted a wave of redemptions for Tether. Joining us now for more is Emily Nicole, Bloomberg Crypto reporter, who is up late for us in London today. So, Emily, walk us through the latest report from Tether and whether things have materially changed for them since then.
So in this latest report, what we can see is exactly how Tether was affected by the crash of Terra USD in May. That was a pretty large stablecoin by all metrics, but the way that it was different was Terra would use a mix of algorithms to determine how it kept its peg with the dollar, whereas Tether uses a reserve of assets, usually cash and cash equivalents. Now, what we see in this report is that over that quarter, those assets, as you said, dropped by about 20%. It went from $82.4 billion in the end of March to around $66.4 billion in assets by the end of June. And that's largely because as things started to unravel with Terra, people then started to offload their holdings of Tether into other assets or perhaps cashing out of crypto entirely, which meant that the stablecoin provider itself was forced to start offloading some of those reserves that it had to meet the redemptions it was being asked for.
Emily, Tether said it changed its attestations, changed accounting firms for its attestations, last month, with this being the first one issued by its new partner, BDO Italia. Why is this worth paying attention to?
So regulation is on the horizon for all of crypto, but for stablecoins in particular, it's very front and center. It's the thing that regulators are most likely to deal with first because it looks the most like a traditional sector. In the UK, the rules are like they want to make stablecoin issuers as if they're regulated as if they're non-banks. And in the US, some of the rules look about how transparent are these issuers being about their reserves? How frequently are they filing these reports? And so for Tether, its previous partner was a Cayman Islands-based firm called MHA Cayman, a subsidiary of a UK accounting firm, which was roughly part of about the 10th largest accounting network in the world. BDO is in the 5th largest. So this was a big step up for them in terms of, legitimacy of how the reserves are being looked at. However, this is still an attestation. It's not an audit. So all the report does is really you have an accountant look at the numbers that it is put before us from Tether and say, these numbers look like they roughly work out to what management has said the accounting policies it wants to follow.
And Emily, we only have about 30 seconds left, but what about Tether's stablecoin rivals?
So the interesting part about the attestations and the reserves report there is that a lot of Tether's rivals, at least the biggest ones like Circle's USDC, they start those reports pretty much more frequently than Tether does. Circle moved over the weekend to issue those attestations now weekly rather than monthly, which is what it was doing before. Tether said in this last report that it wants to move towards monthly attestations soon. It hasn't yet given a time frame for that, but that'll definitely all be part of how Tether and its rivals can move towards appeasing regulators in assuring them that perhaps these dollars are really backed by what they say they are.
All right, Bloomberg's Emily Nicole, thank you so much for that reporting. And that's going to wrap it up for Bloomberg Crypto this week. But join us again next week, same time, same place, 1 p.m. New York time, right here on Bloomberg.